Thanks for joining us. Interesting format, so look forward to getting your feedback afterwards as to whether this has been in line with expectations and whether you found it useful. So Charlie and I will run through the slides in the traditional fashion, and hopefully you can see the first substantive slide with you now. So on the screen, just a quick summary of the highlights of our first half year ending 31st of March. And I'm sure you remember that the 31st of March was a date that was still very much in the depths of the crisis, COVID-19 crisis that we're all still living through. But very pleased to report that Impax has had robust performance across all dimensions during the crisis. And with staff working from home, we're operating a resilient company. Over the first 6 months of our financial year, we've had record levels of net inflow, so £1.8 billion of net inflow. We've had positive net flows every month during that period, and that's continued into H2 for April and May. And we are really very pleased also that our investment performance has been solid. So assets under management at the end of April, end of the first month of H2, had bounced back to 15.8 billion. Next slide, please. So a quick summary of the financial highlights. So the first half shown in the bold column, and then the previous two halves shown by comparison. So you can see at the end of March, assets under management had leveled at 14.4. So April really was a very strong month. During the first half, our revenues and adjusted profits were up. IFRS profit was down slightly, as Charlie will explain, but we have also been able to announce a 20% increase in our interim dividend. And again, more details from Charlie, but very pleased that we've been able to make solid progress on the dividend. Next major slide, please. Maybe it's two more. Oh, no, sorry, that one. Yep. So the COVID-19 crisis, of course, has presented a number of challenges for everyone in the world, and for those of us running businesses, we've had to very quickly transition from being in the office to being all at home. So we've now got 170 staff working from home, and that was very successfully transitioned. We have, of course, as a regulated investment management firm, had to have business continuity processes for many years, and those have been rehearsed on a frequent basis, but that only involved about 20% of our workforce in terms of sort of physical relocation for working. We've now got 100% working from home, and that's all been very successful. We've been, of course, ensuring the communication between team members has been as frequent as necessary, and being responsive and sensitive and sympathetic to individual circumstances. We've also gone a long way to communicating with clients to ensure that we understand their concerns, their questions, their needs, requirements, and by and large, because our funds have performed well during the crisis, we've not been on their radar screens for sort of problem solving, but actually in contrast, many of them have been looking to explore opportunities to allocate new money to us because we're deemed to be investing in areas that are resilient and oriented towards long-term success. The challenge going forward now, of course, is to try to reopen offices in a measured fashion in line with regulations, requirements, but also the views of staff. We are anticipating a structured reopening in September for our London office, with probably trials going on before then. And obviously that will be in line with government guidelines, particularly around the use of public transport. But we're also going to be, over the long term, assessing the opportunity and staff preference for more working from home. And that might involve some readjustments to how teams are structured and operating. It is quite interesting as we reflect on the career development prospects of more junior staff and the need to ensure a healthy corporate culture. We do feel that the need to be getting back into the office to some degree, even if it's only on a part-time rota, to sort of increase the frequency of person-to-person interactions and general sort of social glue, which we think is essential to having a healthy culture in the long term. But in summary, our COVID-19 response has been very successful, and there is increasing sign that investors are intrigued by what Impax is offering, and the prospects for our business probably have not been better for a very long time. Next slide. Thank you. Just a quick summary of the business. You'll have seen something like this in the past if you've followed us, but the business breaks down really into equity, fixed income, and private equity funds run out of London or New Hampshire in the United States, with thematic listed equity being the majority of the assets under management. We also, during the period, were recipients of the Queen's Award for Sustainable Development. It's the second time we've won that award. It is the UK's highest or most prestigious business award, and we were delighted to be given another sort of 5-year blessing from that institution. Next slide, please. So the next few slides are the customary representation of Impax's assets under management and flows. So this one shows the breakdown by client domicile. So of course, with the assets under management falling somewhat during the period to the end of March, then the dark blue lines, which are the more recent numbers, are lower than the light blue lines from 6 months previously, except in the UK, where we've had a strong inflows both into the St James's Place Global Opportunity Strategy, but also into the environmental markets funds out of Ireland and the investment trust that we run to. Next slide. In terms of the breakdown by strategy of our assets under management, the bar in the middle, where it says unconstrained global equities, that's global opportunities. That's where we saw the most increase in AUM, offset by slight declines in the 3 major strategies, and a fairly flat performance in New Hampshire, albeit on the back of positive flows in New Hampshire. Next slide. The New Hampshire business integration continues to go very well. So we are now 2.5 years into that, and with the sales teams now integrated, that's a recent move. We've now got the sales teams across 3 offices fully integrated under one combined leadership. Then we are making very good progress in harmonizing client service and business development. We have also made further progress in product development. So we've got a new mandate in Canada with NEI, and NEI has hired us to run a balanced fund, which brings together our equity management, listed equity management out of London, and our fixed income management out of New Hampshire. So that mandate kicked off on the 1st of May, but is a material step forward in terms of utilising the New Hampshire investment teams. On the support side, we continue to develop our integration, particularly, for example, around compliance, risk management, back and middle office, and more recently the harmonisation of a common trading desk. And then in terms of the financial position, the business remains profitable. It got down to fairly low operating margin at the end of March. It's not as Charlie will describe, but that's bounced back in April and May. It has bounced back, but it's still quite considerably below the $5.5 billion that it needs to get to trigger the payment under the contingent consideration. And so at the moment, we're not expecting to have to pay out anything under the contingent consideration linked to the acquisition back in January 2018. My screen has switched away from the slides, so I am going to ask you to put on the next slide and also remind me what it is, because I can't actually see it. Oh, there we go. Thank you. You can see it now. So this shows the breakdown by the flows, showing market movement versus inflows and outflows split out separately. Not much to highlight in this slide, except really just to show the significance of the negative market movement over the 6-month period, and the very strong inflows, particularly in Impax London on the left, but also the positive flows in Impax New Hampshire, which is a material improvement since the previous period. Next slide, please. Our private equity infrastructure business has continued to make good progress. So this is the business investing in the development and construction of wind, solar, hydro, and related assets around Europe. So we've now made 8 investments from our third fund across 5 countries, as shown in the diagram, and we are expecting to be completed with the investment period by the end of 2021. So continues to be strong interest in the assets that we're building from final investors, but also in asset owners who are interested in getting exposure to our strategy. Next slide, please. So at this point, I'm going to hand over to Charlie.
Great. Good afternoon, everybody. So it's now my pleasure to take you through Impax's financial performance over this period, a bit more detail, and delighted to see how the business has performed. One point of detail, Ian mentioned earlier on that we quote adjusted measures, and the reason for that is that we regard the IFRS official numbers as, whilst technically correct, and we clearly show those on our statements, as including some items that are less meaningful from an ongoing business perspective. And to illustrate that, Ian just mentioned a moment ago that we think it's unlikely we're going to be paying contingent consideration. That has been the case for probably a year now, and this time last year, the result of that was that IFRS required us to release a provision on the balance sheet relating to the cost of the acquisition. So that flattered the results for H1 2019, giving an illusion of the costs looking lower than they really were. I mention that in particular because some commentators have picked up on the fact that our profit before tax has reduced compared to a year ago, but it's purely down to that effect, that the official numbers are including this somewhat spurious effect of the provision release. So apologies for that bit of detail, but that hopefully explains it. There's more detail in both the interim report and on the slide deck in the appendix. Anyway, to the numbers that we're particularly highlighting, which are the adjusted measures from now onwards. And on the revenue side, we split this out between the London business and the New Hampshire business, left and right. And you can see the London business has primarily benefited from the strong flows and performance over the period. The 2 negative numbers relate to the private equity business, where the second very successful fund is now coming towards the end of its life, and therefore the income is falling away, which is very much part of the expected business cycle. On the right, the New Hampshire business, we see a small positive effect due to the flows and performance. Great to see that. Over the past couple of periods, we've seen outflows. So the inflows that Ian's talked about have now come through and starting to generate to positive growth in the top line. Overall, the run rate revenue is 77 million at the end of March. Again, noting that the markets at that point were particularly depressed versus today. Can't give you an exact up-to-date number as of May, as the month has only just finished, but clearly the markets have performed strongly since March, and that number would be considerably higher by now. So turning to the next slide, which is operating costs. We've again got the left-right split, and we split costs up into 3 different components. Across both London and New Hampshire, we've been very careful to manage costs carefully. We've always done that, but there's been particular focus since the start of this crisis, the COVID crisis, and that has continued into H2. Commenting first on the left side, you can see that the non-staff costs are very stable period on period, which are the blue numbers. Fixed staff costs, however, have gone up, and that reflects the hiring of staff to support the growth in business. And just referring back briefly, Ian commented on the record growth in terms of assets under management in the first half, which is great to see. And whilst we are very much a geared business, we do need to expand our capabilities to support that business and to provide for future growth opportunities, which relates to that cost. The grey bar represents the variable remuneration, which for Impax London is determined at 45% of the operating profits before that charge. So that's edged up, and as a result, the variable remuneration cost has edged up as well. That cost covers all things to do with variable remuneration. That's both cash, bonuses, and staff equity, and the national insurance are all fully captured within that. If we look on the right, we see the Impax New Hampshire results, and here we see that costs have actually gone down on the non-staff side, and that reflects certain costs within the business model in New Hampshire that are paid by the manager relating to the funds. So this would be things like fund administrators, etc., which in Europe are normally paid for by the funds directly, but here go through our books. Those costs are typically charged on an AUM basis, so go upwards and downwards with growth or shrinking of the business. So with the fall in the market towards the end of the period, we've seen a saving on those costs, which is a good protection against the falling that you get on revenue. Other items in terms of staff, you can see are very stable over these 3 periods quoted. So when you put that all together, the operating, sorry, can we go back a slide? Thank you. The operating profit is 10.5 million for the period, which is similar, slightly up on H2, and that's in spite of the COVID crisis. The operating margin overall is a robust 25%, which I'm very pleased with in the context of the backdrop. As of the end of March, that has dipped to 23%, which is not a surprise because the market clearly is lower than it was over the course of the period generally. The flip side to that, of course, is that with the market strengthening back and going up to higher levels, then that operating margin can very quickly recover from the 23 up into 25 and indeed beyond into the later 20% type range, which is more along the lines of what was being expected. Thank you. Next slide, please. So just touching briefly on this slide, it's meant to show the short-term development of our cost base. So you can see that there have been some hires that, as I've just referred to. The reason looks like quite a big hire in London is because the hires by coincidence in H2 were towards the end of the period, whereas in H1 this year, they've been at the start of the period. And so that's really an averaging effect that's going on there. But I think the main thing we're trying to draw out is that whilst headcount has gone up, the cost per employee has gone down, and that's entirely deliberate. That's because we're hiring at the mid and junior levels, as broadly speaking, the sort of senior infrastructure is already in place. Moving on now to the next slide, 17. The earnings per share is quite straightforward this year. The main changes from the second half last year is that H2 19 included a couple of items that are not repeated relating to revaluations. So the main thing that's happened in this period is quite simply the increase to operating profit, which is nudged up. So we have 6.3 pence in this period. And again, that emphasizes, if you compare that back to this time last year, the 4.4, you can see the strong growth in earnings over this period. On the dividend side of things, after the final results last year, we announced a new policy of paying in normal circumstances between 55 and 80% of adjusted profit after tax. And the board is still committed to that policy. Clearly, we're only at the interim stage at this point, and there's still a number of months to go of this financial period, and quite a lot of uncertainty within the market as to exactly how things will play through. So the interim dividend that's been announced is a combination of the great progress the business has made and prospects for the business, but also an element of caution, steering us towards, at the moment, the lower end of the likely range, pending seeing how the rest of the year goes. At 3.7 times covered, however, that gives us a lot of flexibility to how to manage this when we get to the final level, and there's clearly scope for for comfortable dividend rises if we continue at the sort of current market levels and business momentum. That's everything on that slide. So then moving on now to the balance sheet, which is slide 18. The balance sheet comprises cash, which I'll talk about here, also seed investments, and there's a slide in the pack you can look at, page 25, showing that we have 5 million currently deployed on various of our funds. These funds are purely there not as speculative investments. They are there simply as part of the creation and management process for our investment capabilities. So 5 million there, and there's no debt. So that's really the balance sheet in a nutshell. Looking at the cash, we have a cyclical low point at the end of March, whereby at this point of year, we've recently paid our final dividend, and we've also paid year-end creditors. So it tends to dip to this point and then rise over the second half of the year back to September again. You can see here on the left the very strong contribution from cash generation over the period, then offset by the payment of year-end creditors I've referred to and the dividends. The only other significant item on here is the acquisition of own shares. And for those of you that don't know Impax, just to explain that, we have a number of successful share schemes for staff. I've already mentioned that the cost of those schemes comes out of the variable remuneration pool that we create. But in addition, the board has a policy to seek to buy shares in the market at market price where there is what we regard as attractive pricing and it's deemed to be a good use of shareholder cash, to seek to mitigate the dilution. And that's been very effective to date in doing that. So in this period, we've bought approximately 1 million shares at a cost of 3.2 million. So those are the main movements. That 19.9 million of cash. Just to give you the right-hand bar chart gives you a feel for how we regard that cash. It's a comfortable balance. We need to earmark an element of that to cover things going wrong, a risk buffer, if you like. So that's a regulatory context and a sensible risk management context. And that gives us 9.4 million of what we deem to be available. The most obvious thing we'll be spending that on is the interim dividend that we just announced. So the resulting 7 million that is at this point unallocated is available for further share buybacks if we choose to do that, further seed investment, or indeed business developments of any other nature as it might come along. That we would expect to grow modestly over time, but it will fluctuate upwards and downwards depending upon exactly what opportunities come along. And we're not intending for that to grow to any massive size, but it's at this stage it's a nice healthy balance. Moving on to the final financial slide, which is slide 19. This is looking at the shareholder register, where we provide a quick bit of transparency around exactly what the different numbers mean. There's quite a few different versions of denominator you might pick up when you're looking at different data sources. But simply, we have 130 million in issue, and to date we've bought back a net of 5.6 million shares, whereas there are at the moment unexercised equity awards for staff of 8 million. So that indicates that were we to need to not make any further purchases, there'd be a 2.4 million shortfall. Whilst there's no rush at all, because a lot of those awards don't vest for some many years, if they were to be issued as new shares, there'd be 132.8 million shares in issue at that point. So that's why we use that number on the right to say who owns what. And you can see on the right that BNP owns 24%, employees are very healthy, 29%, and there's a free float of 47%. Ian, I think that's all I was going to say.
Thank you. So just the final slide is summary and our outlook. I think it's fair to say that Impax's strong and differentiated investment philosophy around the transition to a more sustainable economy as a signal for business prospects and outperformance for investors continues to resonate with asset owners around the world. We do have 90% plus of our client base overseas and in a large number of countries and different channels, and we are seeing solid commitment to our strategies and funds and increasing levels of interest. As the COVID-19 crisis subsides, I think we are pretty confident that levels of inbound inquiry will remain robust and probably pick up potentially quite significantly. The company now has a wide range of well-established strategies, particularly in the equity class. We do have scope in fixed income and private equity to materially expand what we're doing, and so we're going to be thinking over the next few years about how to do that. But meanwhile, in the active equity and passive equity space, we do have plenty of scope for further growth on the existing platform. The integration with New Hampshire has gone very well, and we are anticipating being able to expand our North American footprint quite considerably in the coming years. Our staff are working effectively under the current constrained situation and demonstrated through a number of projects, including the NEI mandate, that they can produce quite significant levels of performance, high levels of performance in spite of the current constraints. So with a strong positioning in the market, a solid and increasing client base, a scalable business model, we do feel confident in being able to continue to expand on the financial results of the firm over the medium to long term, and that should translate into an ability to pay higher levels of dividend as markets normalise and the economies get back on their feet. So I think that's probably a good time to pause, hand back to Hannah, and I'm very happy to take some questions.
Thank you, Ian. Just as a reminder to everyone, you can submit questions via the question button, or alternatively, you are welcome to drop me an email at hannah@equitydevelopment.co.uk. But we do have a couple in already, so this is a nice sort of broad brush question to begin with. But given the growing importance that we've seen people attach to a more sustainable way of life, particularly in the ongoing pandemic, how is Impax differentiating itself in what it feels to be an increasingly crowded ESG space?
Well, I think the starting point is that we're really well differentiated in the context of our authenticity, which is based on 20 plus years of track record and a set of services which are entirely dedicated to sustainable development. We're not just bolting on ESG onto a generic product range, as many groups are. The investment performance, of course, is absolutely crucial to our ability to attract new clients. So that's remains an edge. And beyond that, I think we're also benefiting from the efforts we put in the recent years, let's say the last 5 or 6 years, to both extend our research in areas like climate change risk, to step up and report on effective engagement with companies to help them improve their governance and firm up their strategies, and our ability, for example, to report on environmental impact and social impact metrics. So yeah, we're definitely not complacent, and recognise that part of the success of what we and a number of others have been doing for many years is bringing in a lot of competition into the market.
Well, testament to your success. Moving on then, we take a look across the pond. Obviously, Impax New Hampshire didn't quite live up to your initial best expectations in the first 18 months. So what do you think has changed now, or what have you changed over the last year to improve that?
Well, yes, I think as Charlie mentioned, the end of 2018 was a particularly miserable period for US mutual funds in the retail space in particular. And so the flows into our New Hampshire business were negative in 2018 and the first part of 2019, but they have turned around and are now consistently positive. I think that reflects a number of factors. Crucially, it reflects improved investment performance, which is an area that, of course, we've been focusing on with the team over there. So the funds have been rising up their peer group rankings. Mm-hmm. Secondly, the 3 crucial funds have reached their 3-year anniversary at the end of 2019. So at that point, they get on the radar screen of a large number of advisors and distributors in the US, which require that 3-year track record. And I think also the fact that we've been able to provide some additional support and extension of the sales and client service team has led to more success. So yeah, I think we're in the middle stages of improvements. Still some way to go, but the signs are very positive.
Good encouragement. Now, a specific one here, probably more for you, Charlie, but can you provide an indication of the operating margin in April 2020?
Sure. It's clearly higher than the 23 I quoted for the end of March due to the market rise and ongoing inflows. And I don't have an exact number for you, but I'm confident it's now above 25%, but whether it's 26, it's in that type of range.
Okay, thank you. And have there been...
Now as of April as well.
Sorry, I missed that, Charlie. What was that?
It would be higher at the end of April due to the end of May due to the ongoing rise even since April.
Thank you. In addition, have there been any issues in trade debtor recoverability since the end of March?
No, this never really has been a sort of significant risk for Impax. The way that we collect our fee is directly from the funds and accounts. So there's clearly plenty of assets within those funds. So we've never had a trade debtor issue. We always get paid very quickly within the end of soon after the end of each period. So the answer is no.
Thank you. Now, perhaps if we take a bigger, sort of broader look at growth prospects, what is it that you think prevents you from winning larger pension endowment style mandates?
Well, I think we have been winning larger pension style mandates. We reported last year several mandates in the sort of $200 million, 200 million euro range. We won another large mandate with the West Midlands Pension Fund, which is, we can't disclose the amount, but it's definitely in that ballpark. So we're pretty pleased with that, certainly a material improvements on the scale of the mandates we were winning, say, 3 or 4 years ago. Could we get bigger mandates in the future? Well, I think there's 2 types of opportunity. One is the discrete institutional mandate along the lines I've just described, and it's possible. We're certainly seeing RFPs along the lines of 300 to 500 million pound global equity type opportunities, where our global opportunities strategy, the one that we're distributing in the UK through St James's Place, are ideally placed to attract more money. So some irons in the fire there. And then the other opportunity is around wholesale distribution, where the initial mandate might be a couple £100 million, like we found with St James's Place, but with solid performance and distribution muscle from our partner, then there can be rapid growth. So we've seen the St James's Place mandate more than treble in size since we launched it just 18 months ago.
Okay, thank you. And then perhaps as a final one, obviously the pandemic is still with us at the moment, so perhaps it's a little premature. But as you look across the industry, do you see new strategic offerings coming up onto the horizon that you can go out there and drum up new business with?
Sorry, we say strategic offerings. Can you
a new mandate, a new strategy that you can go and sell to your investors?
Yeah, so there's 2 angles for that sort of growth. There's new channels for the existing strategies that we run, and then there's new strategies themselves that we can originate. So yeah, there's plenty more in both categories to go for. We're still light relative to the market opportunity in both North America and also places like Australia and Japan in terms of the size of our client base. And it makes most sense to take existing strategies and proven track records into those markets more comprehensively. So we're both seeking organic growth through our own sales efforts, but also particularly out in the Far East and Australia, looking for additional distribution arrangements. And then there are additional investment strategies we can consider seeding and offering to clients. So just over a year ago, we launched an actively managed version of our gender fund, which is a global equity strategy exclusively investing in businesses that are run or with boards dominated by women. And that's actually been outperforming the global market quite nicely over 12 months. And we're expecting with another year or so track record to be able to take that out to investors. We do have a couple of other ideas that we're keeping under wraps at the moment. Impax's history has been one of cautious product origination and avoidance of sort of a sense of asset gathering. And we've been very keen to be seen to be backing a small number of ideas rather than being all things to all people. But sustainable development is producing a lot of new market opportunities, a lot of exciting companies in different areas that we haven't hitherto been covering, for example, in financial services. And so we're not being shy in exploring those. So yes, there's definitely more to come from Impax in both those dimensions, but we're not in a rush.
Very sensible. And I think your point about not being all things to all people helps to maintain that differentiation you're looking for in this market. Lovely. Well, thank you to you both. Oh, I beg your pardon. We've got a couple more questions come in. I think we've got time for them. Who do you see as your main competitor?
Well, for the clients who are investing in our thematic funds, then historically the main competitors have been in the UK, Jupiter and BlackRock, and to some degree Robeco, Simm out of Zurich. Those groups, of course, are still around and offering competition. I think our global opportunity strategy is competing to some degree with one of the Lion Trust products. And then more internationally, we're seeing Generation Investment Management, who have a global equity product, and groups like Nordea, who've got thematic equity products as well. So at the product level, it's very much depends where exactly the mandate is being examined. At the level of the management company, there isn't really another listed company like Impax anywhere in the world, as far as we know, that's dedicated to sustainable development. Of course, there is a peer group on AIM and in the main market in London of fund managers, investment managers who are running mandates in the same sort of financial model that we are. So Polar Capital, Premier Miton, Lion Trust is sort of in our peer group, but they're of course doing different things. They've got different business models. So yeah, it depends exactly what you mean by competition.
Well, I'm sure that's helpful for the investors that are listening to give them a bigger picture of the space. But I think that really is the end of the questions now. So thank you again to both of you. As a reminder to everyone who is listening, we should have a note out in the next couple of days. And if you are desperately keen to watch it back, we will have a recording out of this probably tomorrow morning. So thank you again, and we look forward to seeing you next time round.